on long-lived assets. Our first LOS asks us to distinguish between costs that should be capitalized and costs that should be expensed. So, when we incur a cost, there are two treatments. Either we can capitalize it. Why? What is this about? It means storing the cost in the balance sheet and then releasing the cost to match against higher future revenues. So spreading the cost of an asset over its life to match against revenues. Of course, we should expense an item, which means immediately put it through the income statement when it's incurred if it does not lead to higher future revenues, because there's nothing to match the cost against. So general rule is, if a cost is going to lead to higher future revenues, higher future earnings, i.e. there is a future economic benefit, we should capitalize it. If it isn't likely to lead to higher future economic benefits, or those economic benefits are uncertain, we should expense. So our capitalized costs include expenditures necessary to prepare the asset for use. So when you're looking at things like property, plant and equipment, it's not just the cost of purchasing that PP&E, but it's also the cost of shipping it in and getting it ready and up and running. Now, once it's up and running, then subsequent related expenditure typically cannot be capitalized unless it improved the earnings quality of the asset. Okay, so for example, unless it provided more benefits in the future, then they cannot be capitalized. So in other words, costs that sustain the asset's usefulness have to be expensed, such as repair and maintenance, whereas costs that improve the earnings potential of the asset may be capitalized. What's the impact on the financial statements of capitalizing versus expensing? Well, of course, if you capitalize, you're storing the cost in the balance sheet and then releasing it over its life via depreciation. That means, of course, your assets are going to be higher if you capitalize compared to expensing. And if your assets are higher, so too is your equity. If you like, if you expense, then you've got, of course, lower net income because the full cost goes through in the year that it's incurred. Lower net income, lower equity because your retained earnings are lower. Now, of course, if you capitalize, your net income in the first year is going to be higher because you'll just see 1 year's worth of depreciation. Whereas if you expense, it's going to be much lower because you've got the full cost going through in that year. But in future years, if you capitalize, you still feel the pain via depreciation that's being spread over the asset's life. Whereas if you expensed, nothing's going through in subsequent years, so you get higher net income in later years. Notice, therefore, that capitalization gives you lower income variability because essentially you're spreading costs over time. Now, what that does tend to mean is return on assets and return on equity. Remember, return on assets, net income over total assets. Return on equity, net income over total equity, tend to be higher if you capitalize. Why? Because net income tends to be higher in the first year under capitalization, but lower under expensing. However, in future years, remember, net income, if you expense, is going to be higher. So you tend to get a lower return on assets and equity under capitalization in future years than you do as if you'd expensed. So in other words, you get an improvement in ROA and ROE in the first year, but in later years, if you capitalize, but in later years, it's worse than if you'd expensed. Debt ratio and debt to equity ratio. Well, let's think about debt to equity, debt over total equity. Of course, debt's not affected, so it must be equity. Now, equity, of course, is going to be higher if you capitalize because, of course, your retained earnings are higher because your net income in the first year is higher. So higher equity gives you a lower leverage ratio if you capitalize compared to expensing. CFO, if you capitalize something, then the cost goes through cash flow from investing, not cash flow from CFO. So if you capitalize, you'll have a higher CFO, but a lower CFI. Whereas if you expense an item, then of course it doesn't go through your cash flow from investing, it goes through your cash flow from operations. So under expensing, you get lower CFO and higher CFI. We're then asked to talk about capitalizing interest costs. This is a specific situation where a firm is actually constructing assets that it will then use. So it's constructing its own held-for-use assets. Okay. Now, of course, the idea is that you should include all of the cost of constructing the asset. You need to accurately measure the asset's cost and then, of course, match it against revenues in the future via depreciation. Now, of course, one of the costs of constructing your asset is interest, the interest on the borrowings that are used to finance it. Now, of course, the interest rate that the interest that we're going to be allowed to capitalize is going to, number one, be project-specific debt, and then any unrelated debt, i.e. any general pool of debt that is not specifically linked to something else. Okay. So any interest expense on debt in excess of our construction cost is expensed immediately. Let's have a little look. Oh, no, before we have a little look at our example, we've just got one more slide to go. So capitalized interest is going to be reduced by income earned from temporarily investing the debt proceeds under IFRS. Oh, yeah, whatever. What it's saying is if we've got excess debt, you could invest that would earn interest, and therefore interest paid is reduced by interest received until you actually spend the proceeds on the debt. Yeah, okay. Once construction is complete, any capitalization of interest has to stop at that point, and then future interest will go through the income statement as per normal. Capitalizing interest costs, of course, results in higher interest coverage ratio. Remember, your interest coverage is EBIT over interest, and what we're saying is if we capitalize interest, i.e. include it in the cost of an asset we're constructing, and of course that's in the balance sheet, your interest expense in the income statement is going to be lower. So you've got a lower denominator, and as a result it looks like your interest coverage ratio is better than it truly is. As a result, most analysts aren't fooled by this, so they tend to reverse the capitalization of interest when calculating the interest coverage ratio, i.e. take all of the interest that's been capitalized out of the asset in the course of construction and put it back through the income statement. Okay, and as a result the interest coverage ratio would look lower then because it would have a higher denominator. Okay, so let's have a little look at an example here. We've got a company, it's constructing a machine it's going to use in its production facility. The average cost of the machine in process is 2 million. All that means is we've incurred a total cost of 2 million in construction to date. The firm borrowed 1 million at 5%, and the firm has a 6 million pool of general debentures. Now what that means is we can assume that 1 million of this of the cost to date has come from the specific debt at 5%, and we can assume that the other 1 million has come from our general pool of debt at 10%. Okay, so let's have a look at the interest that will be capitalized. The construction debt, 1 million at 5%, 50,000, and 1 million from the general pool of debentures. Notice the total cost here, 1 million and 1 million adds up to 2 million, the total cost we've incurred in process to date. So 1 million at 10%, 100,000, so we would be allowed to capitalize 150. It would be added to the cost of the asset that we're constructing. The interest expense going through the income statement, easiest way is just to add up your total interest and then deduct what you've capitalized. So 50,000 on the construction debt, 6 million at 10% general pool of finance, 600,000, deduct what we've capitalized, 150,000, and you can see therefore that 500,000 will be going through the income statement. So notice therefore that the interest in the income statement is 150,000 lower than the true interest that the company is paying. Oh, we've got a question. Firm aggressive capitalizes certain expenses that firm conservative does not. In year X0 compared to firm aggressive, firm conservative will have. Well, firm aggressive, if they've capitalized, firm aggressive will have higher assets because that asset is those costs are being capitalized and treated as a long-term asset. So firm conservative will have lower assets, not higher assets. Lower leverage ratios, remember debt over equity, well, firm conservative will have expensed, of course, the full cost, giving it lower net income, lower retained earnings, and as a result, lower equity, and as a result, higher leverage. So the final one, lower ROE, net income over equity. Remember that firm conservative will have lower net income and as a result lower ROE in the first year but higher ROE in subsequent years. So the answer should be C. Good. Alright, let's turn our attention to intangible assets, and we're asked to compare intangible assets. The good news is this seems to be almost a word-for-word repetition of what we've seen in a previous reading, so we will try and go through this with some form of speed. Now, intangible assets, of course, are assets, long-lived assets, so assets held for continuing use, but ones that have no physical substance. And remember, we talk about identifiable intangibles, which these are ones that could essentially be separated from and separately sold by the firm. and unidentified intangibles that cannot be separated from the firm. Remember, we gave the example of goodwill. Now, remember, if we have a finite-lived intangible, they have to be amortized, but indefinite-lived intangibles, i.e. ones that do not have a finite life, do not have to be amortized but are subject to annual impairment review. And remember, we gave the example of goodwill being an indefinite-lived intangible earlier on. Now remember, internally developed intangibles typically have to be expensed as incurred. It's really only purchased intangibles that can be capitalized, because those are the only ones you can put a reliable dollar value on. There are some exceptions, and here are exceptions. Classic one is research and development and software development costs. Now, research costs, both are IFRS and US GAAP are consistent. They both say expense as incurred, because it's just too uncertain whether this will lead to higher future revenues. Development costs, of course, are where the two differ. Now, development costs involve the translation of research into producing an actual product. Now, IFRS says development costs should be capitalized if certain criteria are met. And those criteria, rather nicely, are outside the scope of our syllabus, but they all relate to seeing whether it's likely to lead to a profitable future product. So if you meet the criteria under IFRS, you capitalize your development expenditure, product development. US GAAP says no, you expense development costs, because you don't know with enough certainty whether it will lead to a profitable future product. So notice US GAAP is actually a little bit more prudent here than IFRS. The other one to note in there as well is the software development costs. Remember, if you're internally generating your own software, if you're generating your own software to sell, then any costs in establishing technological feasibility are expensed. Once technological feasibility has been established, then you may capitalize. So here is our software development. Software developed for sale, as we just said, any costs incurred in establishing technological feasibility have to be expensed. Once technological feasibility is reached, then any future cash flows, any future costs can be capitalized. Now, of course, the problem is, how do you know when the software is technologically feasible? The accounting standards say the software does what it's meant to do, but how are your auditors going to detect this? So it could be manipulated by an unscrupulous company. Notice software developed for internal use, IFRS says exactly the same as software developed for sale. So any costs incurred in establishing feasibility, expense. Once feasibility is established, capitalize. Notice US GAAP takes a different approach and says you can capitalize the whole lot, the costs incurred in establishing feasibility and future cost as well. Purchased intangibles. Now, typically, of course, our intangibles, when we purchase them, are recorded at cost, historic cost, purchase price. If you purchase them as part of a group, what do we mean this? As part of an acquisition of another company, then our proceeds, the price that we paid, is allocated based on the fair value of each asset. What's it really saying here? Well, it's saying essentially that you revalue a company that you've acquired, and you revalue any of its intangibles to fair market value at the date of acquisition. Okay, intangibles obtained in a business acquisition. Notice as well, identifiable net assets are recorded as fair values. This is when we're acquiring another firm, and the difference between purchase price and the fair value of identifiable net assets is reported as goodwill. And of course, we covered this earlier. Right, okay, so then we turn our attention back to the depreciation of long-lived assets. Now remember, historic cost, sometimes referred to as gross PP&E, is the purchase price, any installation costs, any transportation costs, any cost of getting the asset into its current condition or current location and working condition. Once the asset is being operated, then any additional costs, unless they improve the earnings potential of the asset, are expensed. Remember, accumulated depreciation is nothing more than a running total of the depreciation that's been charged to the income statement to date. And net book value is simply gross PP&E minus accumulated depreciation. Notice net book value, we could talk about it as being the balance sheet value of the asset, the carrying value of the asset, the book value of the asset. Now, economic depreciation is the decline in an asset's value because it's been used for one period rather than sold. Be aware, of course, accounting depreciation is not the same as economic depreciation. Accounting depreciation is all about spreading the cost of an asset over its life to match against higher earnings, whereas economic depreciation is the decline in value of an asset due to the passage of time. So when you talk about your car depreciating, you're talking about its economic depreciation. So let's have a look at our depreciation methods. We've got three really, that we need to be able to compute in the exam. Straight line depreciation. Key with straight line depreciation is you get a constant depreciation charge in each period, often used for financial reporting purposes. Well, typically under US GAAP it's going to be used. Under IFRS, it says, IFRS is a little bit more tight here, and it says the method of depreciation that you use should match the earnings potential of the asset. Now, an accelerated depreciation method, and there's only one that's testable in our exam, and that's double declining balance. What this will do is it will give you more depreciation in the earlier years and less depreciation in the later years. And of course, IFRS says if the asset's earnings potential is high when it's new and lower when the asset ages, then you should use an accelerated method. Units of production method calculates depreciation based on usage rather than time. Now, you should be aware that the total depreciation charged over an asset's life will be the same under all three methods. It's just that the timing of depreciation will differ. Okay, now remember, we are asked to calculate. Okay, so we can calculate. So here is our straight line depreciation, how we work out the annual depreciation charge. It's cost minus salvage value divided by asset's useful economic life. In other words, in order to work out depreciation, you need to know the salvage value of the asset and how long you're going to use it for. Both accounting estimates. Notice with double declining balance, the calculation is slightly different. It's net book value at the beginning of the year, i.e. cost minus accumulated depreciation at the start of the period, times 2 divided by the asset's useful economic life. This 2 divided by useful economic life is why it's called double declining balance. Now, you have to be a little bit careful here, because this formula would depreciate the asset below its salvage value, and you must stop depreciating the asset when you hit salvage value. Finally, units of production method, we take cost minus salvage value, so in other words similar to straight line, and we multiply it by the number of units used in the year over the total capacity of the item. Let's have a look at each one in turn. Okay, so at the beginning of year one, a firm has purchased a new machine for £4,000, I should say. The machine has an estimated life of 4 years, or 1,000 units of production. Salvage value is going to be £500, and we're going to produce 400 units in year 2. Calculate the depreciation expense in year 2 using the following methods. Okay, straight line. That's going to be fairly straightforward. Double declining balance, and then finally units of production. So let us start with straight line. All we need to do is take cost less salvage value, so 4,000 minus 500, 3,500, divide that by the useful economic life of 4 years, and we get a depreciation charge of £875 per annum. Okay, let's look at double declining balance now. Now, in order to work out double declining balance depreciation in year 2, we need to know the asset's net book value in year 1. Okay, so we need to work out the accumulated depreciation in the double declining depreciation in year 1. Remember, under double declining balance, it's opening net book value times 2 over the asset's useful economic life. So in year 1, net book value is 4,000 at the beginning of the year because there is no accumulated depreciation. Multiply that by 2 over the asset's life of 4 years, and we get a depreciation expense of 2,000. Now, notice therefore that the net book value of the asset at the beginning of year 2 is its cost minus the accumulated depreciation to date of 2,000, i.e. essentially 2,000. So 2,000 times 2/4, and you get 1,000. Notice we've got no problems here because we're still above the salvage value. Net book value would still be above the salvage value. Net book value at the end of year 2 would be 1,000, and it's still above the salvage value of 500. Units of production method, 4,000 minus 500, so cost less salvage value times the number of units produced in this year over the total number of units the machine is going to produce in its life. So 400 over 1,000. And that gives us a depreciation expense of 1,400. Okay, so what are our impacts on the financial statements? Now, straight line typically gives you a lower depreciation expense in the earlier years of the asset's life compared to accelerated. So accelerated gives you higher depreciation in the earlier years, and then as the asset ages, of course, that depreciation drops. Now that means, of course, in the earlier years, straight line is going to give you a higher net income because you've got lower depreciation expense compared to accelerated depreciation. Because of the higher depreciation expense, you'd have lower net income. Now, of course, that means under straight line in the earlier years, the asset's going to have a higher net book value, cost minus accumulated depreciation. Given that the depreciation is slower under straight line, less depreciation, bigger net book value. Whereas under accelerated depreciation, because you've got greater depreciation, of course, cost minus higher depreciation would give you a lower net book value, so you get lower assets. Now, equity is higher under straight line. Again, if net income is higher, retained earnings are higher, so equity is higher. Under accelerated, of course, lower net income and as a result, lower equity. Return on assets, net income over total assets. Under straight line, you have higher net income and higher assets. It's the numerator that wins this particular fight, so we typically expect to see a higher return on assets. Under accelerated, therefore, it's going to be lower. ROE, net income over equity. Well, again, both net income and equity are higher. Again, net income is more likely to dominate this relationship because it will be a bigger number than a smaller number than equity. So as a result, you tend to get a higher ROE under straight line in the earlier years. Turnover ratios, sales divided by total assets. Well, of course, sales are the same under both methods, but because straight line gives you a higher asset figure, it will give you a lower asset turnover figure. Cash flows, exactly the same. We'll find out later that accounting depreciation is not tax allowable. Why? Because of the level of subjectivity in terms of useful economic life and salvage values. Now, we're also asked to be aware of the estimates used in our depreciation calculations. And we've mentioned them already. They're the salvage value and the useful economic life. These are deemed to be changes in accounting estimates, not changes in accounting principle. Now, remember, if you change an accounting estimate, you do not need to go back and restate prior years. So if I change my salvage value in useful economic life, I disclose it in the footnotes, but do not restate prior years. So if I make the useful economic life bigger or the salvage value bigger, I get lower depreciation. If I do the opposite, make salvage value in useful economic life smaller, I get more depreciation, and I do not need to restate prior years. Be aware that changing depreciation method, maybe accelerated to straight line, is deemed to be a change in accounting principle, and you would have to restate prior years. Component depreciation, I just have an awareness of this. It's required under IFRS, but permitted under US GAAP, and as it's only permitted, they don't tend to use it in the US. Let's imagine that you've got an office building, and it's, of course, that office building has the building, it's got lifts in it, air conditioning in it, etc., etc., etc. Now, component depreciation means each asset within the building needs to be separately depreciated. So you'd need to depreciate the building, the elevator, the air conditioning, the fixtures and fittings, carpets, all at different rates under IFRS, under component depreciation. US GAAP would just allow you to depreciate the building at one rate. So amalgamate the entire cost and just depreciate the whole lot at one point in time. Ooh, a little question. Accelerated depreciation methods, what do they tend to lead? Higher book values than straight line? More depreciation, lower net book values. So that's not right. Result in lower net income in the earlier years and higher net income in the later years. I like this. There's more depreciation earlier on compared to straight line, but less later on. That sounds good to me. Allocate larger proportions of their cost to later accounting periods. No, it's the other way around. Larger proportions to earlier accounting periods. So our answer is indeed B. Now, our next LOS says describe and calculate the amortization of intangibles. Good news is, really, most intangibles are amortized on the straight line basis. Remember, intangibles with finite lives should be amortized over their useful life. And strictly speaking, the amortization method used, i.e. either straight line or accelerated, should match the consumption of benefits. If it's difficult to establish the benefits that the intangible generates, then typically straight line is used. Remember, intangibles with no finite life, i.e. an indefinite life, such as goodwill, has no amortization, essentially because you're spreading over almost an infinite useful economic life. Instead, of course, we must have periodic impairment reviews. Our next LOS is describe asset revaluation. Remember, under US GAAP, all of your assets sit at historic cost minus accumulated depreciation, whereas under IFRS you have a choice. You can either use historic cost minus accumulated depreciation, or you can record your PP&E intangibles at their fair value. Now, of course, you may have revaluations below historic costs and revaluations above historic costs. So if fair value has fallen below historic cost, then the balance sheet asset is reduced to its fair market value, and the loss below historic cost, i.e. the amount of fair value below historic cost, goes through to the income statement. Now, if the asset's fair value recovers in a future period, you can reverse the amount up to historic cost back through the income statement. Any fair value amount above historic cost, that gets taken directly to stockholders' equity. What about a revaluation above historic cost? So if fair value is above historic cost, you essentially increase the asset to its fair market value and you take the unrealized gain directly to stockholders' equity. So what's it really saying? If fair values fall below cost, then you need to take the element below cost directly into directly to the income statement. But if you've got revaluations above cost, then you take the unrealized gain into equity. Right, impairments of long-lived assets. Certainly need to be able to explain these for the exam. Now, IFRS says, look, you need to annually assess for any indications of impairments of your long-lived assets, such as declines in their market value or physical condition. Now, an asset is actually impaired when the book value, i.e. its carrying value, and here we use historic cost minus accumulated depreciation, when its carrying value is greater than the recoverable amount. Now, what is the recoverable amount per IFRS? It's the higher of two figures, either fair value minus any costs to sell the asset, or its value in use. Now, value in use is very subjective because it's the present value of the cash flows generated from the asset's use and disposal. Okay, so if the asset's impaired, you essentially write down the asset to the recoverable amount in the balance sheet, rather like charging a gigantic depreciation charge to bring its net book value down. And the other side is it appears in the income statement as a huge, as an unusual or infrequent item. Now, under IFRS, if essentially the recoverable amount increases in a future period, you can reverse impairments up to the original loss that was taken through the income statement. Now, US GAAP takes a two-step process. First of all, you have to identify an impairment, then you have to measure. Now, you identify an impairment by comparing the asset's carrying value to the asset's estimated undiscounted future cash flows from use and disposal. Now, if the carrying value is greater than the cash flows that the asset is expected to generate, then you move to step two, loss recognition. Now, essentially, if the asset is impaired, you need to write down the asset to its fair value. Now, if you don't know the fair value of the asset, you have to use the discounted value of the asset's future cash flows from use and disposal. And that loss goes through the income statement. Notice as well, you are not allowed to reverse impairments of assets held for use. Under US GAAP, you are allowed to reverse impairments on assets held for sale. Remember, an asset held for sale is an asset that you were using in your business, but you've now decided to dispose of. You stop depreciating it, but it does get subject to annual impairment reviews up until the date of disposal. And here is assets held for sale. So, assets held for sale, as we said, once the firm decides to get rid of an asset, then it gets transferred from held for use into held for sale, and we have to test for impairment. Now, once it's in the held for sale category, we no longer depreciate it because it's no longer going to be generating future revenues. There's no higher earnings to match the depreciation against. However, we do need to check for impairment. And impairment is the same as normal. We check to see if the carrying value is greater than the net realizable value. And if it is impaired, we write it down to net realizable value. Now notice both IFRS and US GAAP does allow you to reverse any impairment that's gone through the income statement if the asset subsequently recovers in value. So let's have a little look at an impairment example here. We've got some machinery owned by Milano company. It cost 500,000 euros. It's got accumulated depreciation of 350, meaning it must have a carrying value of 150 euros. The expected future cash flows that the asset generate is 145. The fair value of the asset is 140. The value in use, which remember is the present value of the expected future cash flows, is 130,000 euros, and the selling costs are 20. And we need to calculate the impairment loss under both IFRS and US GAAP. So first of all, of course, under IFRS, the book value is 150,000. The recoverable amount is the greater of value in use and, of course, fair value minus selling costs. Value in use is 30,000. Fair value is 140,000 less the selling cost of 20,000, 120. So in this case, we'll use value in use. So the impairment, 150 minus 130, 20,000 euros. So you reduce the value of the asset in the balance sheet to 130,000 euros, and 20,000 euros hits your expense in the income statement as an unusual infrequent item. US GAAP, first we need to identify the impairment, and remember we compare the carrying value to the undiscounted cash flows. So the carrying value of our asset is 150,000 euros. The undiscounted cash flows, i.e. the future cash flows, are 145,000. Because the carrying value is greater than the undiscounted cash flows, we do have an impairment. Now, in order to measure the impairment, we compare the book value to the fair value. Notice no talk about selling costs here. So 150,000 compared to the book value, compared to the fair value of 140,000. So under US GAAP, we would have had an impairment, an impairment of 10,000 euros. Right, impacts of impairments on financial statements, essentially. Well, in the balance sheet, of course, it's going to reduce your assets because the asset is being written down to its recoverable amount. And liabilities, of course, are reduced as well. Why? Because you get a reversal of deferred tax liabilities. Now, don't worry about this. I'd wait until you get to deferred tax before you start thinking about this. Now, of course, the other side is in the income statement, and it goes through as a big expense. And if it goes through as a big expense, it reduces net income. And if it reduces net income, it reduces stockholders' equity in the balance sheet. Income statement, well, the loss, of course, goes through this year as a big expense, as rather like a big depreciation expense, and it hits our unusual frequent items. Remember, in future years, of course, there's now less cost in the balance sheet to depreciate, so in future, net income will be a little bit higher. So there is potential for earnings management with impairments. Cash flows, totally unaffected by impairments. Impairments are not tax allowable at all, so they don't go through your tax return. Disclosure, yes, if there is an impairment, first of all, it's going to be disclosed in the footnotes, but it also needs to be discussed in the management discussion and analysis, where you should see the directors of the company, the management of the company, explaining exactly why it's been impaired. How does it affect our ratio? And we're asked to explain the impact of impairment on our ratios. So fixed asset and total asset turnover ratios decrease. Obviously, fixed assets and total assets are lower because of the impairment. And remember, asset turnover ratios are sales over assets. So sales unaffected, lower assets, so you get a higher turnover ratio. Debt to equity ratios are reduced. Debt unaffected, equity is lower. Remember, the impairment causes an expense in the income statement, giving you lower net income, and as a result, lower retained earnings. So you get lower equity, and as a result, leverage worsens, gets higher. Current year's ROA and ROE, net income over total assets or net income over total equity, well, of course, it typically will decrease. Why? Because the reduction in net income is greater than the reduction in assets or equity. So in the current year, you get a worsening due to the impact of the expense in the income statement, but in the future, you get an improvement. Why? Because you've got both lower assets and equity, and of course, you'll have higher net income in the income statement because there's less depreciation going through. Okay, what should we realise as an analyst? Well, if you've got an impairment, then they argue that past earnings have been overstated because we must have had too little depreciation. That's why the value of the asset is too big in the balance sheet. We should also be aware that management has a lot of control over the timing of impairments and the recognition of the size of the impairment loss. Remember, both IFRS and US GAAP used value in use or undiscounted future cash flows. Now, unless you've got a crystal ball, how do you know what the future cash flows of the asset is? So a lot of judgment in trying to establish the future cash flow generation of an asset from use and disposal. And as a result, we could use impairments for essentially earnings management. Okay, now it says, if you've got an impairment, consider revising earnings and cash flow forecasts. Makes sense, doesn't it? Because if we've impaired an asset, it's because its future earnings potential is lower, and as a result, the company is likely to be generating lower earnings, so revise earnings downwards, and lower cash flows, revise things like free cash flow downwards. Our next LOS asks us to explain the derecognition and disposal of long-lived assets. Now, we've kind of seen this already when we were doing our cash flow statements. We know the calculation that the accountants do. They look at the proceeds we received, less the carrying value, i.e. the net book value of the asset at the time of the disposal, and that gives us the gain or loss that is taken to the income statement, of course. Now, what they're doing with that net book value essentially is they're removing it from the balance sheet, both the cost and accumulated depreciation, and netting it against the proceeds and putting that net amount, i.e. the gain or loss, through the income statement. Notice if an asset was to be abandoned, you just put in a proceeds figure of 0. In other words, the loss in the income statement is equal to the net book value of the asset that's been abandoned. If you have a part exchange, then the sales proceeds are simply the fair value of the asset that you've received. And of course, major disposals of long-lived assets should be discussed in both the management discussion and analysis, and you'll see them in the footnotes as well. Remember, as we've said already, whilst you're using an asset within the business, it's treated as held for use. As soon as you make the decision to dispose of it, it's treated as held for sale. And remember, once it's held for sale, it's no longer depreciated, but it is subject to impairment review. Okay, remember, held for sale is the lower of cost of carrying value or fair value less sales cost. So again, all it's saying is, look, be aware impairments when you transfer into held for sale. Right, describe the disclosure requirements for tangible and intangible assets. The carrying value for each class of asset must be disclosed. Remember, carrying value is simply balance sheet value. You need to show the total accumulated depreciation or amortization for each class of asset, and also any restrictions on the asset, title restrictions and assets pledged as collateral, anything that would prevent you from selling these assets. And normally that's because you've used this asset to secure a loan. For impaired assets, you need to show the loss amount and explain why there was an impairment, i.e. the circumstances that led to the impairment. And for revalued assets, which of course is only under IFRS, you need to say the revaluation date, how fair value was established, and also what the carrying value would have been using the historical cost model. What that will, of course, will allow the analyst to do is, if they don't want to have revalued PP&E, they could go back, they could adjust the accounts back to the historical cost version. So if you were comparing one company that revalued with one company that was using historical cost, it would be very easy for you to take the company that revalued and adjust its PP&E back to the historical cost version. Therefore, your ratios would be comparable. Last little LOS here asks us to talk about or compare investment property. Now, you only see investment property under IFRS, and its definition is it's property that is owned for the purpose of earning either rentals and or capital appreciation over the period. Okay, now it's valued at its either cost or fair value, just like PP&E. Remember, the cost model is exactly the same as PP&E, i.e. Depreciated historic cost. Okay, and Fair value model, of course, would be that we record it at its fair value, and any changes in value are taken to the income statement, not comprehensive income. So note, this is the big difference. With our PP&E under IFRS, if we revalue them upwards above historic cost, then the unrealized gain or loss goes directly to comprehensive income, stockholders' equity. Notice here with investment property, that is not the case. Any upwards revaluation, or in fact downwards revaluation, goes direct to the income statement. Notice they need to disclose what model is being used, either a fair value model or a historic cost model, and if they're using the fair value model, they need to explain exactly how fair value has been calculated. If they're using a historic cost model, they need to show the depreciation method used, the useful economic life, and the assets fair value as well in the footnotes.